Last week, within a matter of minutes, Facebook has lost $250 billion in market cap. This was the largest one-day market cap decline in stock market history. Now, does this massive stock price decline offer an opportunity for long-term investors? Is Facebook now a wonderful business at a wonderful price, as Buffett would put it? Or is Facebook or Meta platforms just a value trap, as its underlying value has fundamentally changed? This is something we will discuss in this video, and so without further ado, let's get started. Alright, so let's first of all unwrap what has led to this record-breaking $250 billion stock sell-off. Why did the market react so negatively? Well, I think there are primarily three things you need to be aware of. There are the Apple IDFA changes, then there's increased competition, namely in the form of TikTok, and lastly, there is Facebook's planned multi-billion-dollar spending on the metaverse. Now, before we take a closer look at each of these challenges, investors first of all need to ask themselves why they would consider investing in Facebook or Meta in the first place. What's your investment thesis? Please let me know in the comments down below why you think Facebook as a business has a wonderful future ahead of it. Well, here's my take. I think if you're betting on Facebook, you are first and foremost betting on its CEO, Mark Zuckerberg. But moreover, you also believe that Facebook is one of the best advertising businesses out there, and that digital advertising as a whole will continue to win market share from traditional advertising avenues like broadcast TV, radio, or even billboards. And there is still quite some runway for growth left. According to this chart from Statista, digital advertising spending has not even reached 60% of all ad spending as of now. Now, what's certainly a bit worrisome is that Facebook has for the first time seen a decline in its daily active users. But then on the other hand, daily active users have been flat for quite a while now, and you are certainly also betting on a better monetization of each user over time. So an increase of Facebook's average revenue per user. And to be fair, a much slower growth of users is to be expected when around 40% of all humans are already on Facebook's platforms. Okay, so this is Facebook's core business, digital advertising. It's incredibly profitable, so high margins. It's producing a ton of free cash flow. It's capital light, and the industry itself is growing and probably enjoys a multi-year tailwind. And as of 2022, the advertising business basically represents 99% of Facebook's global revenue. Now, part of an investment thesis in Facebook is probably also that you get a lot of free options on top of Facebook's digital advertising business. WhatsApp, for example, isn't really monetized yet. There is payment. For example, Facebook recently rolled out WhatsApp payments in India. There are opportunities in e-commerce, of course. And finally, there are obviously opportunities in the augmented and virtual reality space. And you could argue that you get all of this at a reasonable valuation, as Facebook is trading for around 15 times free cash flow and around the same multiple when you take a look at operating profit. And in fact, on a relative basis, Facebook is trading at historically low multiples that were last reached during the COVID 2020 stock market sell-off. But there is, of course, a big if here. The valuation is reasonable or even cheap if the aforementioned thesis hasn't materially changed. So you have to ask yourself, has the thesis changed meaningfully? And I think to answer this question, we need to get back to the three problems that I mentioned earlier. Now, obviously, I cannot give you definitive answers here, but I think I can lay out a couple of questions that I think you need to answer for yourself before investing in Facebook. So again, the first major issue are Apple's IDFA changes. If you're not sure what this is, an IDFA is basically a tool that allows digital ad companies to track users' activity across apps to better target ads and to measure the effectiveness of their marketing campaigns. Keep in mind that both Google's and Facebook's ads are or were so effective that people often thought these tech firms were basically secretly listening to their conversation. Now, starting in late April 2021, Apple's iOS created pop-up prompts that ask people if they want to be tracked. Now, I've seen numbers floating around online that state that only around 6% of iOS users in the United States, for example, have chosen to opt into the new IDFA sharing system. And you can imagine what a major impact those changes and the low opt-in rates had on Facebook's core business. In fact, during the Q4 conference call, Facebook's CFO, David Wehner, has actually quantified the impact and said that Apple's changes will cost Facebook around $10 billion. So the first question that you need to answer here is, will Facebook be able to rethink its approach to data collection and privacy? And will they come up with workaround solutions, collect maybe enough data internally that will allow advertisers to achieve the same high return on advertising spend that they have achieved before the IDFA changes? You could make the case that the rather positive Snapchat Q4 earnings, so Snap as a business that faces similar headwinds, might give Facebook investors hope that Mark Zuckerberg and his team will eventually be able to solve this issue as well. Next up, another issue that seems to be affecting Facebook's core business is competition, and mainly the shift to short-form video content. Mark Zuckerberg, again the CEO and founder of Facebook, specifically called out the rise of TikTok, which is owned by ByteDance. Here's what he said during the most recent conference call. But there are two things that I want to call out that are having an impact on our business. The first is competition. People have a lot of choices for how they want to spend their time, and apps like TikTok are growing very quickly. And this is why our focus on Reels is so important over the long term, as is our work to make sure that our apps are the best services out there for young adults, which I spoke about on our last call. So Facebook clearly has its own product that is competing with TikTok, Instagram Reels. But during the Q4 call, Zuckerberg also highlighted that this new form of content, short-form videos, requires a different way of advertising to achieve high returns on ad spend. And this is something that Facebook, but also of course the advertisers, will need to figure out. So certainly in the short term, this trend towards short-form video, which is less monetized compared to other content formats like regular posts on Instagram or story, is another headwind Facebook has to deal with, to quote Mark Zuckerberg here again. We are in the middle of a transition on our own services towards short-form video like Reels. So as more activity shifts towards this medium, we are replacing some time in news feeds and other higher monetizing services. Now I'm confident that leaning harder into these trends is the right short-term trade-off to make in order to get long-term gains. And we've made these types of transitions before with mobile feed and stories, where we took on headwinds in the near term to align with important trends over the long term. And while video has historically been slower to monetize, we believe that over time, short-form video is going to monetize more like feed or stories than like watch. So I'm optimistic that we'll get to where we need to be with Reels too. So a second question you need to answer is, what are the odds of people using Facebook and Instagram significantly less in 10 years or more? Is TikTok maybe a stronger competitor than Snapchat was a couple of years ago when Facebook just copied their core product and introduced Instagram stories? Will Instagram Reels struggle to gain real traction? And can Facebook properly monetize Reels? I think overall you could make the case that Facebook's management team is in a way exaggerating the impact of TikTok and Apple, because by highlighting how much they are suffering, they certainly also want to send a signal to regulators and show that Facebook is by no means a monopoly. Personally, I believe that Facebook's social media networks are more durable than many think. TikTok is certainly competing for time spent throughout a user's day, but I don't think users are going to abandon Instagram, WhatsApp and Facebook. To quote Twitter user Nigel NG here, TikTok doesn't offer the same social element Facebook or Instagram offers. When on TikTok, one is mostly passively consuming content for entertainment, versus Instagram, Facebook, where there's that social aspect of seeing what your friends and families are up to. So yes, while TikTok does compete for user time spent and ad dollars, they don't compete for the users themselves. People don't just abandon Facebook or Instagram for TikTok, as the value proposition is not the same. But again, the durability of Facebook's network is certainly something you should track very closely. And I think this brings us to the last major issue that many investors have with Facebook right now, and which has led to the rather big price decline. Mark Zuckerberg has been very vocal about his ambitions to build the next major computing platform, to no longer depend on other platform providers like, for example, Apple. And Zuckerberg thinks the next major computing platform will be AR or VR devices that basically allow users to access the infamous metaverse. I mean, I think the company's focus is blatantly obvious. I mean, the company was basically rebranded and now carries the name Meta Platforms. And Facebook Reality Labs, or in short FRL, has become a separate reporting unit in Facebook's financial statements. So I think it is very apparent that Zuckerberg wants to enjoy first mover advantages in this AR, VR space. Now I think many people have already written about and talked about this business transition, so I won't get into too much detail here. But I think Facebook's efforts will certainly require a lot of money. As of now, Facebook Reality Labs is simply not producing a lot of profit itself, but at the same time requiring huge investments, especially in research and development. However, this is not something new. During the Q3 call, Zuckerberg has actually already said, in 2021, we expect these investments to reduce our overall operating profit by approximately $10 billion. And I expect this investment to grow even further for each of the next several years. So if those investments turn out to be unsuccessful, this is cash that is not creating shareholder value. It is cash that is essentially not returned to owners. And so of course, depending on what you think of those metaverse investments, whether they can generate high returns on investment or not, or are basically just a cash burn, this will significantly influence the intrinsic value that you ascribe to Facebook. Here's my take on Facebook's metaverse investments. I think Facebook's core business is highly profitable, generating billions of dollars each year. And you are essentially betting on Zuckerberg being a great capital allocator. And I think I trust Zuckerberg that he will not just burn tens of billions of dollars just for the sake of burning cash. If at some point he and his management team realize that the metaverse will maybe not be the future, I think they will realize this early on, and they are hopefully willing to stop those investments then. There is 100% a lot of uncertainty regarding those investments. However, I do think that there is at least a decent chance that the metaverse is a plausible future, and actually love the fact that Zuckerberg as a CEO thinks 10 years ahead and is willing to take such a long-term bet, that he's willing to hurt short-term profitability in order for a greater reward 10 years down the line. As shareholders, we don't want management teams that are just sitting on cash. No, we want management teams that find ways to reinvest profits, ideally at very high rates of return. Now on top of that, Facebook has really accelerated its share buyback program. It may be questionable that they have bought back so heavily in Q4 2021, even though they might have anticipated that the market will react negatively to their Q4 results. But I think overall the fact that the total number of shares outstanding is down almost 2% over the course of just 1 year is something that shareholders should love to see. And the fact that Facebook bought these shares at reasonable, arguably cheap valuations is also something you should like to see. Now I'll do another video in which I take a closer look at Facebook's valuation. This will be a follow-up video, so make sure to subscribe to my channel if you don't want to miss out on future content. And that's it. As always, may your finances and investments prosper. Good luck.